Did you know that Indian households collectively hold over 25,000 tons of physical gold? It is a staggering amount of wealth just sitting completely idle in bank lockers and home safes across the country. We pay locker fees every single year just to keep it secure, while the metal itself earns absolutely nothing. But what if your physical gold could work for you, just like a traditional fixed deposit in a bank? Today, we're breaking down the Gold Monetization Scheme and specifically what this system looks like for an everyday investor in the year 2026, right now. For generations, we Indians have bought physical gold for weddings, festivals, and as a powerful financial hedge against bad times. It is our traditional safety net and a core part of our culture. But let us look at the raw math behind this habit. When you keep physical gold locked away, it is a dead asset. Yes, the overall market price of gold might go up over time, but you're not generating any active yield on the asset itself. In fact, you're paying out of pocket for storage, insurance, and security. Think about the last time you visited your bank locker. You probably paid thousands of rupees in annual maintenance charges just to verify that your ancestral wealth is still sitting exactly where you left it. That is essentially negative compounding. You're paying a premium simply to hold your own money. The Gold Monetization Scheme was introduced by the government to solve this exact problem. It is designed to mobilize all this idle household gold, bring it seamlessly into the formal banking system, and dramatically reduce India's reliance on expensive international gold imports. For the everyday investor, it is a rare opportunity to earn a regular interest income on an asset that usually just collects dust. But the rules of the game have changed significantly over the last year, and what worked for depositors in 2024 certainly does not apply today. So what exactly is the Gold Monetization Scheme? Think of it simply as a fixed deposit, but instead of depositing rupees, you're depositing pure gold. The bank takes your physical gold, credits the exact equivalent weight to your gold deposit account, and then pays you a steady interest rate based on that specific weight. Now here's how the process actually works, step by step, and this is where many people hesitate or get confused. You can't just walk up to a regular bank teller and hand over your heavy gold bangles. First, you need to visit a bank branch that is officially authorized by the Reserve Bank of India for this scheme. They will immediately direct you to a collection and purity testing center, commonly known as a CPTC. These are specialized government-approved testing centers. These centers are equipped with advanced machines to check the preliminary purity of your metal without damaging it immediately. This initial non-destructive test gives you a rough estimate. If you agree with this preliminary assessment, you then give your formal consent for the final melting process. At the CPTC, your physical gold is thoroughly weighed and tested for absolute purity. And this is the critical part that you must understand. Your jewelry will be melted down right in front of you. The center needs to extract the pure gold to determine its exact weight and underlying value. Any precious stones, intricate work, or physical impurities are safely removed and handed straight back to you. Once the pure gold is extracted and weighed, the testing center hands you a formal deposit certificate. You take this official certificate back to your bank branch and your gold deposit account is finally opened. Now here's where it gets interesting, especially regarding the 2026 updates. If you read old finance blogs or watched older videos, you might think there are three types of deposits available: short-term, medium-term, and long-term. That is simply no longer true. In March 2025, the Reserve Bank of India entirely discontinued the medium and long-term government deposits. Those older schemes, which allowed citizens to safely lock up gold for up to 15 years, are gone for all new investors. Today, in 2026, the only active and available option is the short-term bank deposit today. This effectively means you can deposit your gold for a tenure of 1 to 3 years. The interest rate on these short-term deposits is entirely determined by the individual commercial banks, not the central government. Typically, you'll see interest rates ranging between 0.5% to 1% per annum, which is carefully calculated on the physical weight of your gold, not its cash value. Not every bank branch can handle these unique requests. You'll need to look at designated branches of major financial institutions. The top banks currently supporting this scheme include the State Bank of India, Bank of Baroda, HDFC Bank, ICICI Bank, Federal Bank, and Indian Overseas Bank, among a few other select names. But a very common question always arises. Is this system actually safe? Is the scheme entirely government protected? Since the active scheme in 2026 is officially a short-term bank deposit, the default risk is tied directly to the commercial bank itself. However, your deposit is fully covered under the Deposit Insurance and Credit Guarantee Corporation. This corporation protects all your bank deposits up to 5 lakh rupees per depositor per bank. So, if a bank were to fail and could not pay you your gold or money back, you're heavily insured up to that 5 lakh rupee equivalent value. It's the exact same safety net you already get on a standard savings account. Let's break this down with real pros and cons. The biggest advantage is obvious. You're turning a zero-yield liability into an income-generating asset. You earn interest on the wait, you save money on expensive locker fees, and your wealth is held securely by a major regulated bank. But the cons are also quite significant. Because the testing center permanently melts your gold, you completely lose the making charges you paid when you first bought that jewelry. If you have a beautifully crafted antique necklace, its artistic value is gone forever. It is reduced completely to a raw financial commodity. Furthermore, you can't just deposit one small ring. The minimum deposit requirement is currently 10 grams of raw gold. Therefore, this scheme is not meant for your emotional assets or family wedding jewelry. It is strictly built for investment gold like old coins, raw bars, or broken chains that you never plan to wear again. Many investors make the mistake of looking at their entire locker and thinking they should monetize everything. Don't do that. The emotional cost of losing a heritage piece far outweighs a 1% interest rate. You have to clearly audit your locker and isolate only the pure investment pieces. What happens when the scheme ultimately matures? When you first open the account, you have to decide exactly how your maturity proceeds handled. You can either take it back in physical gold, usually given as standard coins or bars, or you can take the cash equivalent based on the prevailing market gold price on the exact maturity date. If you actively choose to receive physical gold, bear in mind that the bank might charge a small administrative fee for refining and casting those fresh gold coins. It is crucial to make this choice wisely. Most seasoned investors prefer taking cash at maturity. Why? Because taking cash completely bypasses those extra refining charges, giving you the exact uncompromised market value of your precious metal, which you can then immediately reinvest into other productive financial assets. Now let's talk about taxes. Today, in 2026, the interest you earn on your gold deposit is completely tax-free. Any capital gains are entirely exempt from taxes. The Gold Monetization Scheme is basically a pure utility vehicle for your existing heavy gold. Everything we covered today is purely for learning. Your financial decisions should always be carefully based on your own personal research and, if needed, seek direct professional guidance from a fully qualified financial advisor in India. Please subscribe to our channel right now. This is Ishwar. Goodbye and thank you.